Howdy guys, welcome back to the Honda Show. Today I'm going to do a video about Dave Ramsey, his advice about mutual funds and market index funds and why he prefers mutual funds over market index funds. So I have seen him give this advice to a bunch of different people at different points in different videos, and the thing is, the reason I thought of making this video is because I have a lot of respect for him. I think he has done a lot of good work, and I think his advice is applicable to 90% of society, because most people have very hard time in keeping their emotions under control and doing the right thing when it comes to investing, or they don't have the time to educate themselves about investing, so they can't really make a lot of decisions. And so if you give them about 10-15 commandments like he does, he has his baby steps, it helps 90% of the population. But if you are watching this content, if you're watching financial content on YouTube, I'm guessing you have a drive to do better than the 90% of the population. Whether you reach in the top 10% or not, there's a lot of luck, a lot of factors in life that happen, but at least you have the drive to try, which is very important. So that's why I think this video will be very important for you, because he gives advice to people about investing in mutual funds and not index funds. I think it's not only about being wrong, I think he's being dishonest with his audience. He is being dishonest with the people who follow him and follow each word that he says as gospel truth.
They're the measuring stick. What we're trying to do if we're creating an S&P 500 index fund is we're trying to create a fund that mirrors what those stocks do as a group. It may or may not hold all 500 of them, but they're doing their very, very best to do exactly what that index does with that mutual fund, okay? So an S&P 500 fund is really going to give you pretty close to the exact rate of return that the stock market gives you.
Now, I might be overthinking right here, but I think his tone, if you look at his tone, the way he's talking to the caller, his tone seems to convey if you buy an index fund, you will do as good as the market does. Not any better, not any worse. So, he's trying to tell you you're just average, and sort of in a negative way. Now, I might be overthinking right here, but guys like him who have been on radio and who have been on television for decades, these guys are masters of showmanship. They know exactly how to modulate their voices and say things without saying them. So I don't think I'm overthinking. I think he's trying to say, hey, if you buy an index fund, you're just average.
As a matter of fact, it's considered the baseline when you measure against it to see if another type of mutual fund is outperforming the market. You see what I'm saying? That's considered the 1.0 on a beta, meaning it's the baseline. And if your fund, if you're graphing it, if the line on your fund's growth is above the S&P, then it's outperformed the market. If it's below the S&P, it's underperformed the market. Okay? A large number of mutual funds underperform the market, but there are plenty of them that outperform the market. And so
now, just look at his last words. Look at his tone, the way he says it. And there are plenty of them that outperform the markets. Come on. Now, all of us who are stock investing or who are into investing generally know that investing is a very difficult game. And you can't just casually say there are plenty of them that overperform the markets, because they don't if you look at the data. So I'm going to put this picture on the screen. This data is from SPIVA. It's part of S&P Global. So they come up with all these data points as to which funds overperform or underperform their indexes, their benchmarks. If you go towards the end of the chart, you will see that 85 to 90% of the funds underperform the index. So when he casually says, well, plenty of them overperform, I don't know what he's saying, because 90% of them don't overperform, they underperform. So what I'm trying to say is, with his voice, with his tone, he kind of beats you down, he kind of humiliates you, and he kind of is being dishonest here. And I will let you know in the video why is he doing that.
The problem with the PBS special is this. The number one reason people retire with no money is not because of rate of return. Okay. And it's not because of the fees. It's because they don't put any freaking money in retirement. And we've got tons of research that shows that. And all of these guys who start ripping on fees or worrying about the 401k structure or from a liberal political perspective, try to figure out what's wrong with America today and that capitalism is somehow bad or something, and they've got that as their undercurrent in a lot of these things. You're never allowed to charge a fee for anything in their minds.
Now, I am personally a conservative guy. I'm not crazy conservative, but I tend to, have a right tilt. And I'm right of center. And I have a lot of libertarian streak in me too. I don't like listening to nobody. And I don't expect anybody to listen to anybody. I think you should do what is good for yourself. And that's how humanity should be, because, that's the only way we can all do good for society. And then he starts going on this political rant as to why PBS, I know PBS is kind of leftist, but when people advise people to have index funds, it's sort of a leftist conspiracy, because most of his audience, they are in middle America, and they love this kind of stuff when he says, it's like a leftist conspiracy and you can charge for nothing. Don't make everything political. This is investments. It has nothing to do with right or left. Don't try to confuse people. So I've heard Dave Ramsey say this multiple times. He says the number one reason people don't have money in retirement is because they don't put any money in their retirement funds, and not because of rate of return or the fees. So what he wants to tell you is, put money in the retirement fund, go to the local provider so they can give him a kickback. I mean, not a kickback, but he gets a small cut. He makes money and he makes his company, Ramsey Solution, into a bigger company, which is not really good for small investors like you and me, because it's a very manipulated way of getting customers. Then you throw in the magic words, research, because research says this. Let me give you some research. Now look at the screen. This is some research from S&P Global, and you can find other researches from other reputable companies which are more reputable than Ramsey Solutions. And if you go on the extreme right hand side, look at the column on the extreme right hand side, and at 15 years, 80 to 90% of the funds underperform their indexes. So I'm not really sure what Mr. Ramsey is getting to.
The truth of the matter is that the research indicates that getting people to invest is the primary thing you do first. The second thing you do, if they want to win, is the rate of return that they make on their money. The last thing that's an indicator of whether they end up with money is fees.
Now, this is again really sly. Now, when you put fees at the last, because that's where these guys make their money, from their fees, and you sort of tell people fees is the bottom of your consideration. Don't even bother about fees, because they don't matter. What matters is you put the money in, and then your rate of return, which we are so smart, we'll give you a better rate of return than 90% of the managers, because we are the top 10%. We are the God-ordained people. And then we'll take more fees from you, because what's the big deal? We earned it. We provided extra return to you. The data does not support anything. And where are the fees coming from? They are coming from you. They are coming from your return at your expense.
Do I put money in my 401k? Yeah, I put money in my personal 401k. Is it the only thing I do to build wealth? No, it's not the only thing. But it does keep the government's hands off the taxes, keep off the money for taxes. And if it's a Roth IRA, a Roth 401k, it's growing tax-free. And yes, I recommend 4 types of growth stock mutual funds. None of those were index funds, by the way. Growth and income, aggressive growth, and international. Now, in some 401.
Now, if you look at his advice, he tells you don't buy index fund. I'll give you these 4 types of mutual funds you should buy, which is good enough. And most people think Papa Dave is telling us something, so he should be good here, because, he's a pretty honest guy generally. There are very few things that he does dishonest, and this is one of them. He makes it a point to tell you that none of them are index funds, because subconsciously, again, he's trying to denigrate the index funds just a little bit, just so they go down in your eyes just a little bit more. These guys are showmen. They know exactly how to play with words. They know exactly what they're doing. So beware.
In case, the selection of funds that you're looking at is so bad that your growth fund category could be filled with the S&P 500.
Now, he's recommending you 4 different types of funds. On an average, most mutual funds, even sectoral funds, have between 100 to 200, 300 stocks. Now, if you have 4 different stocks, at this point in time, as a fund manager, you're nothing but a closet indexer, and you're charging your customers 30 to 40 times the fees. And let me tell you, this is standard practice in the financial industry. And this is why the rich always stay rich, because they manage the finances for you, and you always stay poor.
Now, in some 401ks, the selection of funds that you're looking at is so bad that your growth fund category could be filled with the S&P 500. Your aggressive growth could be filled with a Russell index, which is the aggressive growth.
So your growth fund index is basically S&P 500, and he's saying that it's bad. Why is it bad? Because why are you paying 40 times the fees if it's S&P 500 just named different, and aggressive growth is nothing but Russell index just named different? He says it's bad, okay?
Index fund. If there's an index fund in there, that's fine. I'm not against that.
Yeah, and then he goes on to say, that's fine. I'm not against that. Why? Because when the local provider sells you that fund, he gets a little cut off of it.
Look at your mutual funds inside that you have the opportunity to select, and in every mutual fund perspective, there's that S&P trend line, baseline, and then the trend line of the growth on your particular fund, and you can see if the fund you're looking at has a track record of underperforming the market. If it does, don't use it. Use an index fund.
This is probably the most sane statement that has come out of his mouth in this video. He says, well, if the fund is underperforming the index fund, well, don't use it. Isn't it common sense? Don't you have common sense? We all have common sense. We are smart enough. He's not being objective. He's not telling you how long should you observe the fund if it's overperforming or underperforming. Because sometimes by luck, some fund managers pick stocks and they tend to outperform the index for 1 year, 2 year, or 3 year. But if you look at the picture on the screen, again, go to the right hand side of the column at the extreme right and see all the funds. Read the names of the funds. Look on the right side. At 15 years, 80 to 90% of the funds do not outperform their indexes. So how long are we supposed to track the fund before we know it's good enough, and then we invest in it? And after we invest in it, what is the guarantee it's not going to be in the 90% of the funds that's not going to outperform the index? So, he's not giving you any objective advice.
But
let me ask you this. Are all mutual funds managed, so all mutual funds have those different levels of fees?
no, there's
So I like this caller. Even after Dave giving him a rant for so long, he's still persisting with the fees question, because fees is the only thing you can control. So he's a pretty good guy. He's listened to his rant, but he's still back to the same question. Do all the funds have the same fees? That is the most important question.
no. There's no load funds and there's loaded funds. All mutual funds have some fees. A no load fund means no commission. That's what that.
Remember, only buy a no-load fund. This is not the 1970s or 80s. No-load fund is what people buy now. If you're giving commission to anybody to buy a fund, you are nothing but a fool.
That means. But it has a maintenance fee. And the maintenance fee comes out every single year. The commission comes out only at the beginning. So what you're looking at is not if they have fees. You're looking at what's called the expense ratio. When you look at the prospectus, you can look at that. And you want to look at it averaging over 10 years. What's the average annual expense from all the fees? They're lumped into that one ratio in your prospectus. And it's federal law. It has to be in there, okay? And you're looking at that. Here's why you look at that. Let me give you an example. This is a great call, by the way. Thank you for asking these questions, because it's real helpful to teach everybody this. On a no-load fund, there's no commission, but they charge an annual maintenance fee. Now, if they charge an annual maintenance fee that's 2%, and they do that over 10 years, then their average is going to be 2%.
2% average fees, those numbers, they make my ears burn. I mean, those numbers are seriously from 60s, 70s, 80s. I don't know what world is he quoting things from.
Where a loaded mutual fund with a commission might have a 5.75%, most of them do, commission on the front end.
That stinks. If you're paying 5.75% front loaded, run away from that salesman
when you buy it. And then the maintenance fee might be 0.5 or 0.6. And when you run that math out, it's going to be cheaper than a 2% annual maintenance fee with no commission over a 10-year period of time. So your expense ratio.
These numbers are outrageous. 5.75%, 2%. These numbers are from the dinosaur age. These numbers don't exist today. If anybody tries to sell you funds like these, run away, beat the shit out of that person, throw him out of your house.
Can be cheaper with a loaded fund. Your total expenses you're paying over a 10-year period of time can be cheaper than a no-load fund. But it's not always so. So if you're real concerned about expenses, then you look at that expense ratio, and it's the true up. It's how you compare apples and oranges between a commissioned fund and a non-commissioned fund. Does that make sense?
Yes, sir.
And so you look at the average through there. But here's the thing. Listen to this. If your expenses are up 1% higher average over a 10-year period of time, but you make 4% more rate of return, you came out.
So what he's trying to tell you is buy active funds, preferably through his own endorsed local providers, so he can get a little fees. And then he tries to manipulate by saying, if you get 4% extra and we charge you 1% in fees extra, you're still better off.
I can do that. I can do that.
That's why return is your primary measure of how you pick a fund. That's your primary measure. The last thing I look at is expenses, and very seldom do I find expenses being the deal breaker.
This is nothing but straight up scam artistry when he says the last thing I look at is fees, and that is seldom the deal breaker. Why? Because return is the most important measure. How do you know what return you're going to get? The markets can be down, the markets can be, the markets can go nowhere for decades at a time. So how do you know what return you're going to get? The only thing you can control is fees. He's being scam artist here.
And that's the reality. That's not theory. That's the reality. Good question.
The reality is he's being a scam artist. Now, don't get me wrong. I love picking stocks. I love active stock picking because I think it's a great intellectual exercise. I love stock picking. It's not that I don't love stock picking. Stock picking is a great intellectual exercise. And I think every adult should do stocks because that helps you understand how the world works. It gives you a very good intellectual framework of how the global economy works. But when you do stock picking, keep this in your mind that 9 out of 10 times you will be an underperformer because that's what the data tells you. As long as you have that in your mind, you're good. But don't keep more than 10% of your funds in that bucket. 90% should go to index funds. Keep 10% in the bucket in which you're trying to pick active stocks and trying to generate some alpha from the market, which is okay. So let me conclude the video. The reason why index funds beat any other form of investing is they have low fees, they are very tax efficient. But don't get me wrong, if you have funds that are inactive funds and which have gone up considerably in the last 10-15 years, I don't want you to sell those, pay taxes on the capital gains. Just going forward, put your money in index funds. You would be better off. Alright guys, that's it for today. See you in my next video. Hopefully you make good choices and make good money and live a happy old life.